TCS dominates Mindspace today, and for some time now, the IT sector, IT investors haven't exactly got a relief from the numbers. So to pour more into the finances and the human resources, we have the heads of those verticals, Samir and Milind, with us. Well, Samir, let me straight away get to brass tacks. This is what I've been trying to prod with even the analysts. Can we expect an improvement in margins like round the corner simply because attrition is going down and labor can't get more expensive in the US because of the tightening measures? So how soon can we expect that turnaround?
So we have structurally worked towards it through the last year, and that should continue. So if you looked at it, we in the peak of supply side challenges, we invested in capacity at scale, and we brought in fresh talent, trained them on newer technologies, and built a talent pool. In the recent months, we have ensured that the attrition doesn't get backfilled and reduced on our lateral hiring intake. And if you see in this quarter's results, we have replaced high cost subcontractor cost with things, and these are the structural ones which we have worked towards on from its perspective, and these would be the cost levers we'll continue to focus on. We know headwinds, we have committed headwinds in terms of increments, and towards that we will work towards looking at the measures which are available, and like it happens in each year, we'll step down in the first quarter and gradually work towards it. It has happened the same thing in FY23 as well, where we out of turn guided you towards it, and we were pretty much happy in terms of how we achieved it, except for the Q4. We were dot on in terms of what we thought about.
Let me just push back to you as well, Milind, since you would be doing the actual hiring. Are you satisfied, or are you confident that the worst of wage inflation is behind you in on-site?
I believe so, yes. I believe so. Overall, in general, means in UK and Europe, we are still seeing significant wage inflation.
Not
US,
in the US.
Not in US as much because of various other reasons, but I think in general, we are okay with this, So, but things will stabilize even further, I believe.
Samir, you spoke about the cost levers, right, to bring in operational tightness. One, reduce the lateral hires, and two, bring down the subcontracting costs. Anything else, or is it just these two that you're exercising?
No, this is what is already in play, and you can look at it. Going ahead, our primary focus, or the levers which are available, are looking at realization and productivity, which is a combination of looking at utilization, because we have invested into it and not all of it reflects immediately. Also looking at subcontractors, we used to operate in 7 to 7.5% range. We went up to 9.2. In fact, we are exiting the full year FY23 number is at 9.2. We are exiting at 8.2%, and that's an arbitrage which is available. Looking at operational efficiencies on other line items would be a structured thing which we will continue across.
What are these other line items?
The non-discretionary, the non-manpower expenses. So while our some of them will go up, there would be levers to balance it out on other line items in terms of operating efficiencies.
Okay, and when do you think you can hit the 25% margin guidance?
So I'll not get into it this time. We'd like to, given and more so given the uncertainties which are currently visible. If you look at it, what started at the beginning of the year, in the last couple of months has significantly changed. So our focus will be to take the headwinds and structurally move towards it, like we do in any financial year.
I was also going to ask that question. Sometime in FY24, some quarter in FY24, we see 25 regained.
Our aspiration would be that. In fact, our aspiration would be get closer to 26 as soon as possible.
Okay. 26 is more like I want to lose weight.
Milind, 40,000 fresher hiring guidance for next year is less than what you hired in the year gone by.
No, we normally, when I tell you last year also, whenever...
No, by the end of it you had hired a lot more,
yes, that's right. Only thing is, if you remember, every time this time I say 40,000, for the last many years. And that is what we actually plan for.
But you know, your hiring numbers for the last 2 quarters, Q3 and Q4, the overall headcount numbers, seem to give a suggestion that you are preparing for some slowdown in demand.
No. Actually, it is.
We've never seen an 821
Yeah, but it
Followed
is.
by
net
a
addition.
quarter
But
where you declined.
you had never seen a 110,000 trainee hire in the past year also, right? So, you know, if you compare those two things, that they kind of match up. You know, we made a call there that we will actually have a significant intake last year, and we spent had a lot of investment in training this year for people, and some of those are still getting deployed, you know. So I think that investment is what is playing up right now, and that is what is reflecting in the hiring numbers.
So what is your utilization now?
We don't give on utilization.
But approximately, is your bench
But
optimally utilized?
But we still can do better on utilization.
You can do better on utilization.
When will the cost of delivery normalize to pre-COVID levels? It looks like growth has.
What do you specifically mean in terms of cost of delivery? The overall.
Yes, overall costs. Will they? I mean,
So if you see, it's a year of transition, as I've called out, from both sides. So post-pandemic, coupled with the supply side challenges which we face. If you look at manpower, BA expenses, that increased, and we are structurally now working towards getting aligned to the cost structures which were pre-COVID. If you look at on the other side, on the non-manpower expenses side, travel, marketing, facilities to an extent were all subdued. They are also normalizing towards that. So we see convergence happening on both sides, and increasingly we would expect it, if you have to get back to our cost structures, it has to converge to the cost structures when we operated in the 26 to 28% band. And more so, if you look at it, if I take FY23 as an example, the headwinds which we had were almost 340 basis points. Okay. 160 is something which is committed in FY23 that came in. 140 was because of the supply side challenges which peaked out in Q2, okay. And that is something, if that was not there, we are, we would still have been in 25.5% range.
Okay, we are being warned that we've overshot time. Milind and Sameer, thank you very much indeed for joining us. So that's the entire TCS top brass, telling us that yes, there are headwinds, but they are giving us some hope that much of it will be conquered in FY24. Back to you in the studios.